The next concept we are going to cover is the breaker block. A breaker block is an order block that failed to hold and flips into a new order block for the opposite trend. For the sake of simplicity, the order blocks are the supply and demand zones, and this is how it works. In an uptrend, we are going to use a bearish breaker block. Let's explain why. We have the uptrend, price making higher highs and higher lows. The pullback having their demand zones, zones that can be valid or not. If they are valid, we know what happens, as we did cover in the first couple minutes of the video. The price breaks the highs and continues the uptrend. But if it fails to hold, so essentially it creates a new lower low. And this is a bearish change of character. Now, we have multiple options to look for setups. So far, we learned that on this situation, we look for a supply zone near the top. And previously, we learned that if there is no significant supply zone, we can look for inefficiencies that create fair value gaps. And both strategies can be used. However, we can also use the breaker blocks. The demand zone got broken, turns into a supply. The new supply is named a bearish breaker block, from which we look for price to reject to the downside once the market hits the zone. And in a downtrend, the market structure creates lower lows and lower highs, with supply zones near the pullbacks. The supply zones hold up until a point where selling momentum decreases and buyers take control over the market. Situation in which the supply zone can get broken to the upside. So basically it creates a bullish change of character. As we have learned, we can look for the demand zones to take the market higher. We can look for bullish fair value gaps, but we can also look for the bullish breaker block. The broken supply zone flips into a new demand zone, which is called a bullish breaker block, and we look for price to hit it and reject to the upside, essentially continuing the trend that recently has reversed. If you wonder why so many entry strategies, well, you don't need all of them. All you need is understanding the fundamentals. So understanding the market structure and liquidity, and choose only one entry strategy and master it before moving into another one. Some traders even combine the strategies, but that is much more difficult. So by using only one entry strategy, you will miss the trades that don't apply to your strategy. But that is completely fine. As much as you learn, knowledge is pointless without a strong discipline and patience. Let's check some examples on the chart. Starting from the left. This market structure clearly shows a short-term downtrend structure, seen by price creating lower lows with bearish breaks of structure and lower highs. This type of that moves significantly in one side, and then shortly after it recovers all the way back. This type of movement is often seen when liquidity is pooled in large amounts in small price areas, most likely a liquidation of buy orders. So taking the stop losses of the buyers to load up and prepare the orders for smart money to push in the exact opposite side soon after. The buyers observed a loss of sellers' momentum and a gain of buying momentum, seen by this more significant upside movement than the other pullbacks from the left of the chart. So many buyers probably have been thinking by this large up candle that the market should soon reverse to the upside, so they were opening buy orders, just for price to take their stop losses, and liquidated their positions. The very aggressive downside movement, coupled with the fact that the market was in a downtrend at this level, validates the following supply zone. After liquidating the buyers, the market drove up to the supply, and instead of holding the supply and rejecting to the downside, the supply has failed and the market broke above it. Since we cannot really predict what's coming, let's assume that we, as traders that use smart money concepts, have sold short this supply zone. So we have gotten stopped out of the trade with a loss, but with the proper risk management, just like we have shown in the previous examples, where we look for at least 1 to 2 or 1 to 3 risk to reward ratio, this means that a win covers multiple losses. So after getting stopped out, the trend reverses, because the market broke the last significant high, essentially changing character into a bullish standpoint. Now we can look for demand zones, or fair value gaps. But on this chapter of the video, we are talking about breaker blocks. Remember from the first minutes of explaining the details about the breaker block, the failed supply turns into a bullish breaker block. So essentially, it becomes like a demand zone, and we can clearly see the price reaction with many wicks that have been bought back to the upside and sellers' momentum decreasing, basically making buyers taking over the trend. Now the market is trying to print a bullish break of structure to the upside, and as we can see, later it did. And the second example for the breaker block, the market was initially on an uptrend, characterized by the bullish breaks of structures and price making higher highs and higher lows. Each swing low becomes closer to the previous swing low, showing exhaustion of buyers and selling pressure. Yet the market continues its trajectory by making higher highs. The change of character happened before, but the reversal was not confirmed. We can easily see how the swing lows broke the last one. So the change of character extends for longer, but the reversal confirms only when the market also fails to create new highs. Point where if we choose to learn and use the breaker blocks, we look for the last demand zone to fail by basically breaking down. So as it did, and the failed demand turns into a new supply zone, as we call it a bearish breaker block, from which price hits the zone, giving traders an opportunity to analyze if they want to place sell-short orders. The markets fill those orders and rejects the price to the downside.